Hey, good morning, everyone. Marty Mazzori here. Wednesday, June 22nd, 2022, with your midweek market snapshot. So we'll go through the 60-minute chart. I'll take you through the monthly just on the S&P 500. Keep this one pretty quick, I think. If you didn't get a chance yet to take a look at the morning note, please do that. Overnight, futures were really ugly. Looked like we were going to give back most, if not all, of yesterday's gain. If you just looked at the movement in global markets, opened up that way this morning. In the morning note, though, I was kind of implying that given some of the data that I showed you on that blog post, wouldn't surprise me to see Chairman Powell strike maybe a bit of a dovish tune as he speaks to Congress today and tomorrow. And I kind of give you the thought process around that, and it's a maybe, right? But if indeed he did, I suspect the market would like that. Now I'm looking at the market right now as I speak, and we went from down 1+% in the Nasdaq. It's up 1% right now. And the S&P is up about 40 basis points. It's not good breadth. That's consumer staples, financials, let's see, defense stocks, semiconductor stocks, industrial stocks, material stocks. Pretty much most sectors are down. But the S&P is actually up. Now, the S&P is really dominated by tech stocks, right? So when the Nasdaq is up a bunch, you should expect the S&P to be pulled up with it. So I'm not saying that there's a lasting rally here. I am telling you, though, as I've been showing you on the short-term charts, it sure looks like a bear market rally set up right here. And then my long video over the weekend, I pointed to several of the data points we track weekly. We're looking at sentiment. We're looking at oversold NASDAQ on the weekly chart. We're looking at breadth readings that are just abysmal, that tend to actually be the conditions of a bounce, but they are, on balance, we're still looking at bear market conditions. Now, I do have kind of a Goldilocks scenario that I think is on the lower end of probabilities, but it is one thing that we need to keep in mind. And a Goldilocks scenario would be an economy into the second half of the year and going into next year that's not too hot, not too cold, and it has to do with global dynamics and some pushing and some pulling in various areas that we're really paying attention to. Let's say, the jury is really still out with regard to whether we're about to roll into recession, how pervasive this high single-digit inflation officially, you could argue that it's higher than the official number, is going to be amid some macro slowing and so forth. So there's kind of some hints as to the potential Goldilocks nature. Every time I mention inflation peaking, beginning to roll over, I know for a fact there are subscribers to the blog and clients who kind of cringe and really want to tell me I'm out of my mind for thinking that, right? What we don't want to do, folks, is we do not want to impose our ideological biases and how we think things should be or want them to be, or we're feared that they are, infect how we think as we try to objectively look at things, right? And our view is a structurally higher inflation view, right? And I'm not saying this to appease those who don't like it when I say inflation is coming off the boil. I'm saying it because that's what we were seeing, and that's what we continue to see. And this was a narrative that was beginning before COVID, right, for us. And it has to do with deglobalization, rising populism, the shift to green energy, all these kinds of things that we think are going to put huge pressure on, particularly the latter, on resources, things like copper and metals and fossil fuels and things going forward. But they're going to come with huge rallies and huge corrections. And right now we're seeing a correction in commodities, which really should be getting everyone's attention with regard to the inflation backdrop. So inflation is not going to be linearly higher. It's going to go through ups and downs. It's kind of a 40s scenario where we had really high inflation, then it came off the boil a bit, but it never really settled back down to the low inflation of the decades previously. And that's kind of our base case here. So we think there are good, smart ways to exploit those probabilities, for the next 5 10, maybe longer years, our portfolio is going to look different than it did the last 10, 20 years. But it's not going to happen all at once. We're going to have corrections. We're going to have these things going on. And we're going to have to recognize when inflation is peaking or plateauing and coming down, and be able to communicate what to expect within the portfolio, and to, at the margin, make smart adjustments. A few weeks ago, we just took a very small position, beginning to scale into treasuries and emerging market bonds. This morning, with treasury yields super high now relative to recent history, and the dollar at crazy highs, but coming off of that a little bit, we thought it would be good to scale in another small amount into treasuries at these levels and into emerging market bonds. And I'll probably get more into the weeds of emerging market bonds at some point, but Brazil always comes to mind when I think about that. Brazil has raised interest rates like 11 or 12 times since inflation really began ramping up. If indeed inflation is going to plateau and begin to come down a little bit, a place like Brazil has huge room, I mean huge room, to cut interest rates. I think the 10-year Brazilian bond, the last time I looked at it, was paying like 18%, right? Interest rates come down, the value of those bonds are going to go through the proverbial roof. So we want to be there when one of two things, or probably both things, happen, and that is inflation begins to quell a bit, interest rates begin to back off. The Brazil Central Bank and other emerging market central banks who have been on top of this and been front-running the inflation, or at least keeping up with it, realize that they can now ease policy, right? It's going to be good for their equities, it's going to be good for their bonds, and we want to be there in both to take advantage of that, despite the really high volatility we're going to get along the way. They're very commodity-centric economies when I talk about Latin America. So as commodities roll over, there's going to be definitely some downside offset to that bullish scenario that I just gave you. But we're not investing with the next 5 weeks or even the next 5 months in mind. We're investing with the next 5 years plus in mind. And we think there are some real important high probability themes that we want to be smart and calculating into how we express those themes within the portfolio and the sizing of that and so forth. But boy, we really see opportunities in this setup going forward, despite all the bad news that you're hearing every single day. And with regard to that, please do not miss the quote that I put in this morning's written blog post. Okay, without further ado, we've got this 60-minute chart, right? This, again, is just a bullish short-term chart. It does not mean that this isn't going to fail, just like this breakout from this pattern failed, right? Right now, though, this is about the strongest bullish divergences we've seen, against what, remains, or, any longer is not really a falling wedge. It looks more like a channel, but we're breaking out of this area again, at least as I speak here today. But I have no delusions that, today's rally is going to last. It's not of consequence to what we do for you clients out there. But I think it is important that you continue to understand both our short-term and our long-term narratives as you filter through, the headlines and the news and the hyperbole that the media throws at you day in and day out. The one-year chart, as I mentioned in the last technical video, we were about to lose our bullish divergence here, but the 60-minute chart was telling us that this is about to turn positive. So now we have a pretty good look right here, right? We could extend this wedge and say we're back into it. And then we have our divergences here popping out of that. You need a really momentum-filled shot here to get through that and to gather some momentum. So I look around and I look at our general macro assessment and the longer term charts, and I'll get to those here real quickly. And I say odds really favor that we haven't seen the worst yet. But on the near term, I want clients to understand that there may be something, more positive, maybe not, but there certainly may be. I can put together enough indicators that I'm not actively looking for, right? Because I'm generally not bullish right now, so I'm not trying to support my narrative, as I'm afraid so many of the commentators out there do. I'm just saying this is what we're seeing, and probabilities in the short term might lean towards something higher, not necessarily, certainly not every day, maybe today, maybe not. But on a very, very short-term trend, subject to failure, of course. Longer term, we're seeing some pretty compelling evidence that we need to be careful right here still. So for what that's worth, folks, again, I probably overdo it, but those of you who really think about this market a lot and really look at your stuff every day, I want you to hear from us, because we're in the weeds every single day and we kill ourselves to be 100% objective and use empirical evidence and a deep wealth of data and indicators, some we put together, borrowing from others and so forth, to give us a perspective and allow us to communicate to you what your expectations should be, both short-term and longer term, and why we're doing the things we're doing on behalf of you clients out there. Okay, this one's definitely going longer than I intended. So just quickly, on the weekly chart, I'm going to say there's just really nothing compellingly bullish here. I could say that we've got somewhat of a positive divergence here on the RSI relative to what the price has been doing. Certainly no confirmation from the MACD. These are just the momentum indicators that we use. And then when we just take a look here, there's a green bar. If you can see it right there, that's this week. So right now, we are 7.3% above our downside target, which this pattern and this Fibonacci retracement level and the 200-week moving average historically says that that's a likely place that you'd want to start really accumulating stocks here. And that assumes that we don't have one of these, which is a recession. In a recession, we should expect to break through that. And so that's really where a lot of our attention is on recessionary forces. And as I suggested in this morning's note, there are some growing recessionary forces that we need to pay attention to. And then on the monthly chart, the sell signal on the monthly MACD is really strong right here. And when you go back historically and you look at periods where you had that, and it's a rare setup, outside of recession, you should be a buyer at the 50-month moving average, which is another 8% from here. If you have a recession, look out below. So I suspect when we begin scaling into areas that are really beaten up right here, probably going to stay hedged because of the prevailing recession risk that's still there, particularly if that comes sooner than later. So folks, once again, thank you for sticking with me longer than I intended when I started. But, this is important stuff, particularly for those of you who are looking at your stuff every day, paying a lot of attention to the financial news and the media. It's really, really important, particularly you clients who, pay us to do this for you, that you know what we're thinking and the basis of why we're doing what we're doing. Thank you, as always, for watching and listening. Appreciate you guys. Have a great day. Bye-bye.